Part 12 Reversal Volume Profiling Strategies. Jack Schwager once said, "Moral: if you can't take a small loss, sooner or later you will take the mother of all losses." Hey guys, welcome back to Part 12, the final section of not just Module 3, but of this course. What we're going to talk about firstly is a certain uncertainty. Now, I really enjoy talking about this topic because I think there are a lot of traders out there that actually fear to take risk. Let me tell you, the most successful traders I know and that are in the industry are not afraid to lose money. The reason is simple. If they know the odds are in their favor, in the long run, they are going to make money. So risking money today for an outcome that's highly likely makes logical sense. Now, the key to unraveling the flux of market-generated information as understood from the context of your own evolving emotional cognitive makeup is to accept the fact that all decisions are made under some degree of uncertainty. Nothing is certain. The key to unraveling the flux of market-generated information as understood from the context of your own evolving emotional cognitive makeup is to accept the fact that all decisions are made under some degree of uncertainty. Nothing is certain, guys. That's the point. Nothing in life is even certain, let alone, the certainty of being successful on any given trade. That is where the fundamental nature of humanity is nothing is certain. The agile mind, however, when properly trained and prepared, can discern in the elegant array of evolving market-generated information occasional patterns that enable the execution of trades that offer greater reward with diminished risk. That summarizes it quite beautifully. In essence, what it's saying is that nothing is certain. Nothing will ever be certain in trading. But with a lot of practice and a lot of specific deliberate approach, you'll be able to teach your mind to accept this risk. And the way you do this is understanding that there are higher probability outcomes that you can learn, such as the strategies I'm developing with you. Note, if you can come to accept and trust that your strategies will work over time and the probabilities are in your favor, you will then also learn to accept risk and take the required risk to achieve success. I think James F. Dalton summarizes this concept of a certain uncertainty quite nicely. He says, to be successful, you have to become a lifelong student of the game, immersed in the markets with an open mind and an inquisitive spirit. Of course, you can also choose to be a spectator, someone who knows a lot of interesting facts, able to recite all kinds of statistics. But the fact remains, spectators can't play the game. The difference between a spectator and you who wants to become a trader is whether or not you have the ability and the mindset to be able to take the necessary risk to achieve the probable outcomes. In the next section of Part 12, we're going to talk about one of my favorite parts of trading, and that is the idea that there is such a thing as wrong. Now, what I'll tell you is that the idea of a trade being wrong or right, or a strategy being wrong or right, it tends to be amongst traders who believe that the markets are binary in a sense. And this again comes from probably a lot of the teaching you find in textbooks, as well as courses, and as well as the so-called market gurus out there. Now, the important thing to understand is there is no such thing as a wrong strategy. There is a strategy with a high probability outcome and a strategy with a low probability outcome. And that's important to understand. Remember, the objective of trading is not to be wrong or right. The objective of trading is to make money. Now, you can develop strategies that don't really make sense. They don't make sense in terms of risk, in terms of scalability, in terms of a lot of factors. And some may deem this a wrong strategy. But at the end of the day, if the desired outcome is green, that is all that matters. So what are some of the things you need to think about when developing your strategy to, develop those strategies? First and foremost is high and low probability. Define your strategy in terms of high and low probability. Then, What is the risk profile of that strategy? Now again, another fallacy in the markets is that, professional traders take, risk reward of 1 to 1 and 2 to 1 and 5 to 1 and 10 to 1. I will tell you, this is absolute hocus pocus. Day traders sometimes actually take inverse risk reward, where we're taking on more risk just to achieve the desired outcome. Now some may think this is wrong, but it isn't. Remember, our objective is to be green. In terms of scalability, sometimes trades you cannot scale up very much. Sometimes trades you can scale up a lot. There is no wrong or right when it comes to scalable. However, keep in the back of your mind that a trade that's not very scalable will only last you so long. And whilst you're trying to get bigger and the objective is to make, bigger trades with more leverage, a trade that's not very scalable isn't necessarily wrong, but it might not, it might mean you need to adjust your strategy or change or use other strategies in the future. In terms of repetitive patterns, some people may think just because a strategy only comes in, along once a year, they may think the strategy is wrong or not worth the time. Again, I tell you, a strategy is good so long as you can find repetitive examples, whether it's once a year or 12, 20 times a year. The important thing is you can repeat the strategy with the same methodology and the same desired outcome. Does the strategy make sense to you? If it doesn't make sense to you, the likelihood is you're probably not going to execute it very well. In this sense, it's probably a low probability strategy. However, if it makes sense to you and you understand what you're trying to achieve based on the principles in the strategy, this will allow you to have a far better, outcome and a much higher probability strategy overall. Does this strategy add to your personality? I find so many strategies, or so many traders asking me, how do I do this trade? Or, why did you do that trade? And my sort of standard response to them is, I don't want to give you my strategies. And it's not because I don't want to share them. It's more because the way I execute and the way I interpret and understand things is very different to everyone else. So one size does not fit all when it comes to various strategies. Therefore, just because you don't do the same strategy as me or other traders does not make it wrong. Do strategies that fit your personality, that make sense to you as a trader. Remember, ultimately, you're the one that has to click on the mouse. You're the one that has to leverage this trade. You're the one that has to take the risk. Therefore, you're the one that must have the trade strategy that best suits your personality. And lastly, does the strategy fit your emotional characteristics? We spoke a lot about, emotional preparing in all your strategies, and one of the key things to understand is if you do not like risk, if you're afraid to sit offside, if you someone who you cannot be patient, if that's one of your weaknesses, well then don't try and employ and learn strategies that require patience, because this is never going to stand you in good stead. So, remember, there is no such thing as wrong. Ultimately, everything leads to the same thing, which is there's low probability and there's high probability. Our objective ultimately is to make money, and that is all that matters. We've been developing your playbook over the last 3 modules. But what I want you to understand is once you finish this module and this course and complete your playbook that you'll be able to take with you, it doesn't stop there. The game doesn't end there. That's just the beginning of the game. These 11 strategies I've developed with you in your playbook is just the beginning. Your objective is to take those 11 strategies, learn them, replicate them, find them, execute them. And then slowly but surely, as you learn more and more about the markets, develop your own strategies, update your own playbook, constantly evolve not just your playbook, but yourself as a trader. Keep developing. Now, once you've mastered the principles of the market profiling tool, it's time to put the theory into practice and develop your own playbook of strategies. This playbook is vital to your future success because it ensures you are constantly recognizing and understanding the principles. Just like a professional athlete practices every day, so too we must practice every day with constant updates in our playbook. Remember guys, trading is a marathon. It takes a couple of years to develop edge, to develop, real skill. So you have to keep this playbook close by, keep updating it and keep developing this playbook. Now, one of the important questions you have to ask yourself and decipher, and again, not many traders know this or have the answer to this question, is where do you feature in the markets? Where is your likely edge? What do I mean by that? When I started as a trader, I was very much, I was a broker before a trader. So when I looked at the markets, I looked at the markets very much from a fundamental perspective, from a trend-based perspective. I never thought that on a day-to-day basis you could actually make money in the markets. By becoming a day trader, all of a sudden I saw a completely different market. I could see how markets could sit tight range bound for so many days, and yet there was still opportunity. And then sometimes when there was a trending move, I could see how larger time frame, bigger players entered the market. So the question you have to ask yourself and be able to answer is, where do you feature? Now, I'm not going to say you cannot be a jack of all trades, but I am going to say you probably don't want to be a jack of all trades. You don't want to be a scalper and a long-term trader. And the reason is because the objective of a long-term trader and a scalper are almost opposite. Yes, we all want to make money, but the manner in which we do and the strategies we employ will be very unique and very different. So today, ask yourself the question, are you a long-term trader that goes with the trend? Are you an intermediate swing trader, which looks for point-to-point and bracketing and moving out of various ranges? Are you a short-term trader, where you focus more on the previous day for clues? Are you a day trader looking for smaller price increments, waiting for momentum and flow? Or are you a scalper with automated strategies with very small risk-reward type plays? Answer this question soon in your career. Once you do that, focus your energy intently on what you have decided to become. Ultimately, a sportsman in, say, track, he cannot be a sprinter of 100 meters and a 10K runner. He's either or either. So today you have to choose. Where do you fit in? Where is your likely edge? Just some final thoughts on, the volume profiling playbook and some key considerations to take into account before we move on to our final stretch of reversal strategies. Now, key considerations. As with any endeavor that involves complex associations, an actionable understanding of the market's developing auction process can only be perfected through extensive observation and study. The world's top chess players are not merely intuitive, but have spent considerable time poring over patterns and potentialities. It's very simple. If you want to be a trader, you're going to need to spend a lot of time developing your skill set and developing your strategies. There is no shortcut. There is no holy grail. There is no signal system that's going to say buy now and sell now. It has to come from you. Then, understanding the concept of probability and risk and reward. What do we mean by this? Well, sometimes if a strategy is 90% likely to occur, it's okay to risk for one reward. Likewise, if a strategy is only 25% likely to occur, it's okay to go for one risk for 5 reward. Keep this in the back of your mind. Understand the game of odds. Remember, it's not a science trading. There's no perfect way. It's an art form. Trade location is key. Make sure whenever you develop strategies, you incorporate the trade location within every strategy you take. Always ask yourself, what am I trying to do in this location? If you find yourself that you're long at the high when no one else is long, you're in a bad location. If, however, you find yourself long where everyone else is trying to get long, you're in a great location. So always ask yourself, is this location good and relevant based on what I'm trying to employ in terms of my strategy? Then, crucial to maintain maximum flexibility. If you are in any trade, regardless of the size, you are no longer flexible and you interpret information differently. This is one of the greatest lessons I ever learned as a trader. What does it mean? It means that the minute you have risk in the market, the minute you put, whether it's £1 per increment, whether it's £10,000 per increment, the moment you have risk in a market, you intellectually have a bias. You are intellectually locked either to the buy side or to the sell side. Don't ever forget that. Sometimes the greatest freedom is to take a trade out of the market, to flatten yourself. Because once you're flat, you can be completely 100% objective. Whilst you have a risk on the table, you are more subjective and more bias prone. Keep this in the back of your mind. Don't hold on to little bits of a trade in hope that you can get a little bit back. If the trade is wrong, get out. If the trade objective is no longer recognizable, get out. If the reason you got into that trade is no longer valid, get out. Don't hold on, because this is going to cause you a bias. Then, the best trades are often those that make you feel most uncomfortable. Let me repeat that. The best trades are the ones that make you feel most uncomfortable. Why? Because these are the trades where there's the least amount of information available to the most amount of participants. Remember, the best trades often fly in the face of adversity. Don't be afraid to go against the trend. Don't be afraid to put on a trade when there's not 100% confirmation from the market. Remember, if the market's giving you 100% confirmation, it's giving everyone 100% confirmation. If a trade is obvious, it's obvious to everyone. Don't be afraid to feel uncomfortable as a trader, because these are the best trades. And lastly, to profit, you always have to take some element of risk. No trade will ever be 100%. There is always an element of risk. Never forget this. On any given day, there is always risk as a trader. Let's now move on and talk a little bit about the different sections of our playbook. Welcome to the final section of strategies that we are going to talk about in Part 12, Module 3. So, reversal trade strategies. Let's define them. Firstly, what sort of time frame players are you expecting to see in the reversal trade strategies? Again, you're going to see all time frame participants. The reason is that, let's say for instance a market is moving lower. As this market's moving lower, we may have algorithmic, short-term and day traders in the market. As prices move lower and lower, they could then run into both swing traders as well as longer-term influential players. These longer-term influential players turn the market back around in a very aggressive nature, and as they do so, both algorithmic and short-term traders and day traders tend to exit those original short positions, buying the market higher up. This in essence means that all 5 time frame players tend to be in reversal trade strategies. In terms of initiative and responsive, we tend to see both initiative as well as responsive. Firstly, we see short-term day traders as well as algorithmic moving prices lower. They then run into longer time frame responsive buyers. Those responsive buyers turn prices back around and then begin to initiate a move higher. In terms of the time objective, reversal strategies can sometimes take a long time to reverse, but they can also take a short period of time. Again, it depends on the type of strategy you're trying to achieve. Make sure you interpret and understand what the time allocation is based on the strategy you are trying to create. In terms of volume and volatility, reversal strategies can show very, very high volume and volatility, as you will see in the examples I show you, but equally they can sometimes show a real lack of volume and volatility as momentum disappears. Again, make sure when you develop your strategies, you interpret them accordingly. In terms of risk reward, reversal strategies can have very, very high risk reward. But note, when you are playing for a reversal strategy, you are technically still against the short-term trend. So it's imperative that you manage risk. Always remember, it doesn't matter how good a point of entry is, if you do not manage the risk, the markets can remain irrational for a lot longer than you think. Always manage risk, particularly when it comes to reversal pattern plays. Then when it comes to momentum, remember, we are initially against the initial momentum. So what we're looking for is confirmation that a market has found some sort of a top or a bottom. Once it's done that, not only are we reducing risk, but we can then go with the momentum in the opposite direction. Now, let's define reversals. Firstly, a reversal is where the other time frame participant initiates. So the reversals we're going to talk about are not necessarily where momentum disappears and the momentum fades, but we're going to talk about where the market moves to prices, whether lower prices or higher prices, and we see influential participants enter the market and initiate in the opposite direction. Those are the kinds of strategies we are going to develop under the reversal strategies. Then, if there's positioning in the market, this is what creates the effective reversal. Take the example again, as prices are moving lower, day traders and short-term algorithms run into responsive initiative buyers. Once these buyers begin to initiate, they then force a response out of any short-term trader and squeeze them out of those positions. That positioning is what creates the aggressive reversal. Lastly, the short-term trend. Remember, reversals tend to be on a short-term basis, so we can see as a short-term trend shift quite quickly. This can be within a medium or longer-term trend. The important thing to understand is that we are looking for reversals within the short-term trend. The two strategies we're going to develop going forward now and for the rest of Module 3 are one, the gap day where the gap is filled, and then the second is tail reversals. Now, let's get started and begin with gap day, gap fill trading strategy. This is strategy 10, the gap day, fill day, and this is the first of our reversal type strategies. Now, before we actually go into the unique strategy, let's just talk a little bit about, reversal patterns and some of the definitions you need to understand that are imperative. So the first thing to understand is when trading a reversal strategy, we are going counter to the prevailing trend. Now this is crucial not just to understand, but to incorporate into any reversal strategies you develop going forward. The reason it's important to understand is that if we do not manage our risk effectively when counter trend, we do expose ourselves to potentially big losses. Now, what you're going to see as I go through the two unique strategies I share with you is that the key element and the key success to executing these trades well is that we pay close attention not just to the timing of the trade, but also to where the risk is and where we are wrong on that trade. Now, most important is that you always identify the risk, but we enter based on a key identifier. Now, this identifier, as you'll see in the next two examples, is very explicit. In other words, once we see the identifier, we merely execute, we put our stop in place that protects us as we go counter trend, and then we just let the trade strategy play out. So let's get into the first of our reversal trade strategies. Now, the gap day. A gap day is nothing more than a range gap. So this is day one profile. The market opens outside whether higher or lower of the previous day's extreme points. Now the first thing to understand before we go through the different types of gaps is what has effectively created this gap. Is it created on fundamentals or is it created on technicals? Again, it's important to differentiate. Fundamental gaps don't always fill. They don't need to fill. If there are significant fundamentals in the market and that market needs to reprice, these gaps don't always fill and can actually leave the gap for some period of time. However, technical gaps, these do tend to fill, and more often than not, they do get filled on the same day or the days thereafter. Now, let's have a quick look and talk about some of the key characteristics when it comes to the gap fill strategy. First and foremost, we need to understand the gap implies the market is out of balance. Now, by definition, as we went through in Module 2, when a market is out of balance, this implies skewed risk, as well as skewed opportunity. So straight away, you should be saying to yourself, well, if we have a gap, we have got an element of risk, but equally we've got a much bigger element or much larger opportunity for upside. Now the key to being successful at trading gap days is to always first and foremost manage your risk. Now let's have a quick look at some of the emotional analysis when it comes to gap days. Remember, as a result of the excess volatility, you can expect to see much bigger movements in both directions. Now with that in mind, don't forget, traders are not used to going a long way outside. Traders are not used to the markets moving aggressively in one direction or another. So by that very definition, make sure you understand the various types of emotions you might experience within the reversal type strategies. Now, some of the key questions with regards to executing this trade. Remember I said we're looking for the key identifier. Well, here it is. So when it comes to a gap day, there are three basic rules. Rule number one. Does the market fill the gap? If so, we give it a tick. Rule number two. Does the market re-enter the previous day's range? If it does, we give it a tick. Now at this point, we have not yet seen our key identifier. In other words, we have not even initiated a trade. We could have been sitting there merely just watching the markets. However, point number three, this is our key identifier. Does the market re-enter the previous day's value area? And this is our identifier, but it's also the point we're going to spend the next couple of minutes discussing the trade opportunity. So, the first thing before we discuss the trade opportunity is to interpret what happens on a gap day. Well, very simply put, we've obviously had a huge surge in volatility, something has shifted the outlook of the markets, and all of a sudden the buyers and sellers are scrambling as price has shifted significantly. Now, what tends to occur is the market gaps open and we tend to see a hive of volatility very early on. Now, straight away, there's a natural tendency when a market gaps for a bias to be in the market. Now, bias means nothing more than positioning, or at least short-term positioning. It's this very short-term positioning that is going to give us our gap day gap fill opportunity. So what happens? The market comes up. Rule number one, it retests and fills the gap. Rule number two, it re-enters the previous day's range. And number three, if it re-enters the previous day's value area low, bang, our control identifier has been initiated and we look for long side trades to target the top of the value area high. Now, the understanding and the logic behind this trade strategy is very simple. Because of the bias in the market, we know there are natural short positions that are shorting with the gap to the downside. As prices come higher and re-enter the previous day's range, we continue to see those short positions hold. However, at some point, we are likely to see a fill of an unwind of these short positions, and that point usually occurs once we re-enter the previous day's most accepted area of value. That is our control identifier, and that is where we execute based on the following. Let's have a look at the next slide, and I can show you how the execution occurs. Let's now take a look at an example so that we can have a look at the execution style required. As you can see in the example provided, the market has gapped higher on the day, higher than the previous day's range. It opens and we see an element of volatility and two-way trade. The gap is filled, so rule number one is ticked. The market then re-enters and holds onto the previous day's range. Rule number two is ticked. We then re-enter this blue line, which is the value area high, and we then execute our short trades looking to target the value area low where we cover. Once we enter the market aggressively below the value area high, we merely place our stop the equivalent of our target. Now, there is another way we can place our stop. We can also place our stop based on the point from the value area high or low to the previous day's extreme, as in this example illustrated. Now the key to understanding is yes, we are going counter trend, but with using the current positioning in the market, as in this example there's short-term long positions, the unwind of that will give us the desired momentum in order to take advantage of the quick unwind of positions. Let's take a look at another example. As you can see in the second example with the German bunds, note how the market opens lower, so we gap lower on the day. We have a relatively volatile initial period. The market then fills rule number 1, and we close the gap. We then re-enter rule number 2, whereby we retest or re-enter the previous day's range. Rule number 3, we re-enter the value area low where we initiate our long trades looking to target the value area high. Note again, this is our target. We look to put our stop below the previous day's low or equivalent to the target used. That is our second example of the gap day gap fill. Now note, make sure you understand not just the importance of reversal strategies, but why they can be highly effective so long as we place emphasis on managing the risk. It's okay to go against the trend. It's okay, to sometimes stand against the herd, so long as you remain objective by managing your risk. Let's take a look now with the replay series at how an example like this would play out and how we can execute on the live markets. So welcome back to the replay series, and we're now going to talk about the strategy gap day gap fill, which is number 10 in our series of strategies. Now, first thing to point out is that the gap fill gap day strategy is actually a reversal type pattern. Now, a lot of you would always have been taught and would have thought about the gap day as a sort of momentum trending type strategy, but a lot of the time these gaps do fail, and that's why they provide us with particularly good reversal opportunities. Now, what I'm going to show is I'm going to go through the 3 types of rules that you can apply to when we have a gap day. But then more importantly, I'm going to show you exactly where the reversal play comes when we have a gap day. Now, just think about that for 1 second. Imagine if every single time you had a gap day. Imagine you had an almost step-for-step process as to how you could execute just by identifying the gap day. Now, more importantly, imagine if you had a strategy that was working, say, 7, 8, or 9 times out of 10 whenever you had this gap day occurring. And that is why I'm going to show you the strategy, and that is why this is a particularly powerful and profitable trade strategy. So, firstly, let's just go through the basic gap rules, when you do get a gap in the market. Now, the first thing we talk about when we get a gap is whether or not this gap is being created by fundamentals or whether it's being created by technicals. Now, the differentiation is important because when we get, let's say, we get some new fundamental information, whether that's an election vote, whether that's a new, huge piece of industry information, whatever it may be, when we get that fundamental that comes into the market is going to change its personality or the way that it moves in a very significant way. And the simple reasoning behind it is that there is positioning in the market. So if there are a lot of positions and now all of a sudden we've got this new information in the market, those positions need to be adjusted, whether they, some people add to those positions, whether some people hedge those positions, or whether some people stop out of those positions. The mere fact that we've got a new fundamental piece of information in the market means that we are going to get a hive of activity and volatility. And that's important to understand because volatility means that the market's personality is going to be very aggressive, or it's going to appear very aggressive. Now, as day traders, a lot of the time, this volatility can make you fear what the market's actually showing you. Now, what I will say, remember, whilst there is a higher risk attached when there is higher volatility, there is also a higher potential for opportunity. So don't forget that. If you embrace the volatility, take on the volatility, you will get the potential upside if you apply a very basic strategy. Now, in terms of a technical gap, this is merely where we've had an overnight move in the market, and this is forcing whichever market you're trading to open on a gap from the previous day's range. Now, the three basic rules to a gap are as follows. First and foremost, you have to ask yourself, if this is our previous day and we gap below it, the question is, will that gap fill? That is the big ultimate question. Does the gap fill? Now, rule number one, if the market opens on gap, there is a high probability the market is going to attempt to test that gap. It's going to try at least to fill in that gap. Now, one of three things can happen. Either the market fails to fill the gap on its attempt, and the market then continues to sort of distribute below the gap. Two, the market can fill in the gap and re-enter the previous day's range. Or three, the market can fill in the gap, re-enter the previous day's range, and even potentially re-enter the previous day's accepted area or value area. Now, we're not going to look at option one, okay? I've spoken about option one, the gap and go type day. We're not going to talk about option two either. What we are going to talk about is the reversal play, which is option three, whereas the market actually re-enters the previous day's range and then re-enters the previous day's value area. Now, remember what I said. We are taking one specific element or one strategy that we are going to employ and utilize when there is a gap day in the market. So let's get straight into it and get the recording going. Now, the first thing to point out is that we're looking, in this case, at an example in the German 10-year Bund, and our key levels or our key reference points are first and foremost the 32s, which is our gap from the previous day or our high from the previous day. Then our second key area of reference point is the 26s, which is the value area high of the previous day, and our third reference point is the 13s, which is our value area low of the day. Now, what we're looking for, we're looking to see how the market responds at these three reference points. More importantly, as I go through the characteristics with you, I'm going to show you the execution style or where you want to be implementing a reversal strategy. So let's get the recording going and we can go through it together. Now, the first thing to point out is that we can see the market has opened on gap. So we've opened roughly with a 6-7 tick gap. The market has now attempted to move itself higher. Now, what we want to pay attention to first and foremost, remember what we said. Rule number one, does the market manage to fill the gap? So we can see that the market's opened and it's yet to attempt to fill the gap. Now, this attempt at filling the gap is where a lot of traders make a mistake. Don't forget, when a market is open on gap, it is opening out of balance. In other words, by definition, a market that is out of balance is going to show a lot of volatility. So remember, it can take a little bit of time for the market to at least test the gap. Now, what I would say, what I would use, for instance, in a German Bund example, is I would use at least the first hour of cash as a reference point for the market to test the gap. So either this M or this N print, I would expect the market to at least just test or see if that market can actually test in and around the gap. Now, as we can see, the market's coming with an M print, it's coming with an N print, and it's trying to now test the lower bounds of the gap. So first and foremost, we could see the market comes into that gap area, and straight away the market bounces off. So it's kind of telling us we're filling in the gap, we've now filled the gap in the market, but we're not willing to enter into the previous day's range. So at this point in time, in this example, we still need to be buyers of the market. There's no reversal option here, there's no reversal strategy. The gap might be filled, but it does not imply we want to be short traders yet. Remember what I said to you, the key to this trade setup is execution. You have to perfect the execution. You have to be patient to wait to take on this trade setup. Now again, notice how the market bounces off and we get a little bit of a rotation higher. So we can see the market is just merely rotating in and above the gap. So rule number one, remember we said, does the gap fill? And we can see we can give that a tick. The gap has now filled. Rule number two, do we re-enter range? Re-enter the previous day's range. And that's the second clue to this trade setup. So we are now about to see this market re-enter into the previous day's range. Now, the important thing to understand when we have a gap day in this example, okay, is that the market will hold the gap, or it will hold the intent or the initiative taken from the gap for as long as possible. So what I mean by that, if for example we have a gap day as illustrated, you will constantly see buyers keep trying to defend this gap, keep trying to hold this gap for obvious reasons. If you were long from this point, you're substantially on side now. So it makes sense to hold on to those longs for as long as possible in the case that we get an aggressive move to the upside. So let's just pause that now and see what's just occurred. So we can see the market has come into the gap, and note how the volatility has shifted. So we can see we had relatively small ranges. We had a nice pickup in the P print. And since then, the ranges have been relatively small over the last 5 sets of TPOs. All of a sudden, on the V print, notice the shift in volatility. Notice the range expansion that's now occurred. More importantly, we're now not just back inside the previous day's range, but we're also now trying to get into the previous day's value area. Now, the key consideration, the key thing to understand is, remember, we had buyers defending the gap. We had buyers holding so long as the gap held. We then saw some stops. So we've now seen, as soon as we entered the previous day's range, we've seen a few of those short-term buyers give up on those long positions, and we've gotten a little bit of a stop out, or the volatility to the downside. Now, that's step number two. We've re-entered the previous day's range. This does not constitute a gap fill reversal trade strategy yet. What we want to see now is we want to see the market close back inside the previous day's value area, and then and only then do we initiate our strategy. So note, this is not the time to be short yet. Okay, we could very easily rotate back higher, and the market could go and continue higher. Now, don't forget what I said to you. When there's a gap day in the market, whether it's fundamental or technical, participants will stay in the direction of the gap for a lot longer than you think. They'll almost be biased in one direction because of the gap. And that's why you have to be patient and wait until the market closes back inside the previous day's value area before executing the reversal trade setup. Let's continue on now and see where that opportunity actually comes. So you can see now the market's now firmly back and below that 164.25, and all of a sudden the market has now closed the V print back in below the previous day's value area. Now, as you can see, the minute the market closed back inside the previous day's value area, at that point, we then instantly rotated to the lower end of the previous day's value area. So again, in terms of execution, this was a relatively quick example. We could see the minute that V print closed back inside below the 25s, we then got the move all the way down towards the 12s. Now, that is the trade we're looking for. That is the execution we're looking for. We're looking for that confirmation, and the minute it confirms, we're looking for short side trades back down towards the previous day's value area, where we look to cover and take our profits. Now, I know a lot of you are looking at this going, saying, well, it's not really, there's not a great deal of opportunity there. If we look at what we've taken in terms of reward, it's probably only equivalent to 50% of the day's range. But remember what I said to you. Gaps, by definition, are volatile. Okay, so once the market gives you that little bit of a hint, that little bit of a clue that it's time to hit the reversal trade, you have to execute relatively aggressively. More importantly, because the market's volatile, because there's short-term positioning in the market, you're going to get paid relatively quickly. Now remember, when you sit in a trade for a relatively short period of time and can get paid relatively quickly, you are executing with a very good or a very strong advantage, which is that you're taking on risk for a very short period of time. And that is why this is a particularly strong trade strategy to not just learn but also develop. Let's continue playing now and see what the market does over the rest of the session. Now, very often what can occur, particularly in the example of a fundamental bias, is the market can actually continue to aggressively reverse in the opposite direction. And the reason is simple. We spoke about the buyers defending the gap. And we spoke about how the market will hold long so long as the gap holds. Now, what often happens is when there's a huge fundamental in the market, buyers don't give up. In this example, buyers wouldn't give up that easily, simply because they are stuck in a bias based on the fundamentals. And that means that when we, for instance, have a move lower, it's not actually sellers moving lower, it's buyers continuously buying the market. And what eventually happens is the buyers go so far off sides on this trade they've taken on the fundamental bias that eventually they give up and we get the overreaction to the opposite side. So remember, with this trade setup, first and foremost, the three rules. Does the gap fill? Do we re-enter the previous day's range? And do we re-enter the previous day's value area? We execute only once we confirmed to close within the previous day's value area. Don't forget, interpret, is this a fundamental gap or is this a technical gap? The technical gap, the probability is we fill in the value area quite easily. Do we extend in the opposite direction further? Potentially, okay? But if it's a fundamental gap, the probability for a much stronger reversal is much higher. That is the key to trading strategy number 10, which is the gap day gap fill. Stick to the rules, apply them to the gap day, and you've got a unique trading strategy. This now concludes strategy number 10. Don't forget, go and apply this to the E-minis, apply them to the oil, apply them to the currencies, apply them to anything. Gap days occur all the time and relatively often. Go and find these examples, and don't forget, the more you practice these setups, the better you're going to get. Practice makes perfect. Welcome to part 12, strategy 11, the final in our series of 11 unique trading strategies. Before we move on to the actual strategy, do bear in mind, however, this is a reversal strategy. By this definition, we are going counter to the prevailing trend. Now, remember, as we spoke about in the previous strategy, it's important that we always manage risk when we are going counter trend. Also of key importance is that we always try to attempt to perfect our timing. And we do this, as we did in the previous strategy, by having a key control identifier. Now again, I will show you what this control identifier is and how we utilize it to perfect entry. So on to the trade strategy. Characteristically, the first thing we want to pay attention to is the tail. Now, as you can see in the example provided, a tail is nothing more than a TPO or a single TPO that comes off either the high or the low. Now, keep in mind this tail can also be hidden in nature, so don't forget when a tail is hidden, it's not as obvious but still has the same sort of principle as a regular tail. Now, in terms of the size of the tail, this is key importance in determining the potential for opportunity. As a basic rule of thumb, the larger the tail, the bigger the reward for opportunity. The smaller the tail does not imply there's less opportunity, but the probability of a large winner is less likely. So that's the key characteristic to understand with regards to the tail. Now also don't forget, and this is not so much a trade strategy we will develop at this point, but another trade strategy is potentially once we take out that tail. Remember, tails become very key reference points in the market, and by that definition, we do tend to see a whole host of stop-outs above and below tails. Let's take a look now at the two types of tails you can expect to see in the tail reversal strategy. Don't forget, the size of the tail is important, but more important is the type of tail that we see. So the first type of tail you're going to see is the symmetrical tail. This tail looks a little bit like this. Now, what creates the symmetry is we tend to see a aggressive, move up towards an extreme. We then see not just responsive selling step into the market, but also initiative selling. This initiative and responsive selling together takes the market quite aggressively in the opposite direction. The second type of tail you can expect to see is a non-symmetrical tail. As the name suggests, this is a tail that we come up in a relatively straight manner. The market then doesn't reverse in an equal and opposite type manner, but rather sort of grinds in the opposite direction. Now, the reason we differentiate between these two types of tails is because each tail will have a slightly different execution methodology. The first type, the symmetrical, we would need to be relatively more aggressive in terms of our execution and entry. So once we see the market respond aggressively off an extreme, we need to be looking to execute with an aggressive type approach. Whereas in a non-symmetrical, we can afford to be a little more passive on our entry and rather sell into any kind of a counter move. Now, before we actually take a look at some of the examples of the tails you can expect to see, let's just go over the fundamental rule of the strategy. Now, the single most important rule in order to achieve the success of the strategy, as well as the control identifier, is we need the candle to confirm the tail. In other words, a tail is only confirmed once it's actually closed. So what do we mean by that? If we see, as this in the example, we see the Y print come up the page, moves aggressively higher, but then manages to close all the way back down lower, this is very suggestive of a reversal type candle. But only once that close has occurred can we then look to execute either in a symmetrical tail manner or in a non-symmetrical tail manner. Now, once the candle's closed, as you can see in this example, we see the Y print come up the page, it then closes, and we can then execute our short side trades. With this in mind, let's take a look at the execution methodology. Once the candle is closed, we merely look to place, in this example, our short side trades with our stop originally or initially above the high. Now, important to understand is when we have a symmetrical type tail, we can afford to trail the stop. Why? Because we are seeing quite an initiative responsive move in the opposite direction. In the other example, where we have non-symmetrical, we need to keep the stop in its original position until such a point that the market shows us a confirmed turning point. Let's now move on and have a look at the different types of tails in an example. As you can see in the examples provided, the first example, we have two nicely graphically depicted tails. We have the T's at the highs and the Q's at the lows. Now again, remember, we said the size of the tail is relatively important, but also the type of the tail. In this example, we can see we have got a non-symmetrical type tail, meaning that once the market does turn, whilst it does effectively reverse, we do see a much slower, less pronounced reversal. Again, we enter only once we are confirmed a tail, we place our stop above the high or the low, and we look to trade this trade back in towards the distribution. In the second example, you can see not just what a aggressive, aggressive symmetrical tail looks like, but also what a hidden tail looks like. So as you can see, this tail is hidden because, well, traditionally a non-hidden tail is one where we can see the single prints. In this example, we can see the Z prints move higher, but then the very next candle, the A prints aggressively reverse. Now, whilst this isn't visually a tail, it is a hidden tail, as we still have the aggressive reversal nature of a tail. Key to understanding when we do have this symmetrical reversal tail is the aggressive nature at which we have to enter, which we can see in the third example. Notice how the Z print moves quite aggressively higher, it closes, and the A print reverses in the opposite direction. Once that Z print's closed and the A print opens, we then look for short side trade opportunities aggressively in the opposite direction. Note the price action response on the next candle, quite volatile relative to the rest of the candles. This then concludes our examples of our various types of tail reversal examples we can see. Let's now move on to the replay series and have a look at how this tail reversal can be executed using a real-life example. So welcome again to the volume profiling replay series. This is the final strategy of the 11 strategies that we've discussed. This will be the last of our reversal type strategies. So I'm going to take this opportunity now just to talk about one or two things before we move on to the actual strategy. Now, first and foremost, what I want you to just bear in mind is that whilst I've shown you 11 unique trading strategies that you can employ in the volume profiling, there's a whole host of other strategies that I could show you, but more importantly, that you could develop for yourself. Now, make sure, once you've done and found all these 11 strategies, make sure you continue to develop these strategies, but also continue to develop your own understanding as well as strategies as you go forward. Remember, trading, it's a very simple art form. The market, price can only actually go up or down. It's us that create a lot of complexity, by having a whole host of reasons as to why we want to do a whole host of different things. Keep it simple, guys. Keep it, almost keep it stupid. Don't try to overcomplicate what should be a simple process. Remember, those who can, control all aspects of their trading, control themselves from clicking, control themselves from taking on a trade that doesn't make sense, those who can remain objective when all else, around them, are becoming subjective or becoming emotional, those are the traders that will succeed in the long run. So, with that in mind, don't forget, this is our final strategy now. I hope you've enjoyed this series, but let's get into it, the final of our reversal trade strategies. Now, the first thing to talk about when we move on to the tail reversal is first and foremost, what is a tail? So if we were to just basically get the basic premise of a tail just represents pretty much premium and discount. So that's the first thing to understand. It represents a premium for sellers and represents a discount for the buyers. Now, two key characteristics to keep in mind is one, the depth of the tail, so the length of the tail, or how long the tail is. That's quite important, as well as obviously the volatility around the tail. Now, what do I mean by that? In other words, we could have a tail that the market comes down and it reverses, but then does something like this, and then slowly but surely rises. Now, that in its own is a tail. We could also then have a second tail where the market reverses and instantly moves in the opposite direction. Now, the volatility and the difference between the two is vitally important. Obviously, in the second example, this is a far stronger rejection that we are seeing in the market. Don't forget, a tail is effectively representing a strong response from the other time frame participants. So in this example, let's say the market moves lower and suddenly, we get this, this move back higher. We could be seeing either initiative from the buyers or equally response from the buyers. And depending how the market reverses will dictate to us, how strong a response we are seeing occurring in the market. Now, another important thing to focus on is that the tail effectively, essentially, becomes a key reference point. Now why? Well, very simply, if a market leaves a tail, and we're seeing, say, in this example, a strong response from the buyers, that strong response should effectively be an important reference point the next time we visit it. In other words, if we revisit it again and then look to take lower, it means that there are buyers that now need to exit those positions. So just bear that in mind. Tails do represent very key important reference points. And lastly, don't forget, we get two types of tails. We get the hidden tail, but we also then get the tail that is not hidden. So we can just write there, not hidden. Now bear in mind, a hidden tail is just where we do not get a single set of TPO, whereas a not hidden tail is where we get a single set of TPOs, whereas a hidden tail would sometimes, it might look a little bit like this. So if we got our initial move up, the market opens at this price but closes at this price, and the next letter we open at the high but we instantly reject and the market closes back down at the low. Now again, whilst that on, say, a traditional volume profile would look like a double top, or would look like the market's kind of, there's no tail, in essence there is, because the market has instantly reversed after retesting the one extreme. Okay, so let's now move into the example we've got. Let's just keep in mind the context. So what you'll see is that we were sitting inside the previous day's value area. So if I were to draw the previous day's range, we were sitting very firmly inside the previous day's value area, nothing really going on. Now let's watch the recording and see how the market plays out over the course of the day. So we can see in very early trade, the market is just sitting within the previous day's value area, nothing much going on. Now, what we want to look for, the characteristics of a tail, is a shift and a change in the volatility. So we'll see a very, very big dynamic shift between how the buyers and sellers respond. Remember what we said. A tail represents either a discount at lower prices or a premium at higher prices. So if by that definition, if prices are representing a huge discount, we should see price reverse quite quickly. And likewise, if price is representing a huge premium, we should see prices reverse equally as quickly. So what we can see in the early part of this example is that the market is merely distributing. It's well within the previous day's value area. It's a well-balanced open. We can see there's nothing really going on, no real opportunity as we remain firmly in balance. The important thing to understand is what occurs once the market breaks away from this area that it's accepted for almost 1.5 sessions. So let's watch the price response now as we move above this 164.70. Let's see if the dynamic shifts, if the dynamic changes somewhat. Now remember, the important thing to remember with the strategy in terms of execution, you don't have to preempt. You don't have to preempt a tail. The profile will show you the tail. When it shows you the tail, you then want to execute based on the manner I'm going to show you in a couple of minutes. So just remember, you don't have to rush in terms of this. It'll be quite obvious when there's either a tail or a hidden tail. And with that in mind, just remember, guys, the major difference between a hidden and a not hidden tail is when a tail is hidden, a lot of the time you will get very well rewarded for spotting it, okay? Because it's not as obvious as a tail that's not hidden. You won't always see the tail that is hidden, and therefore if you do manage to pick it up and observe it quite early, you do get rewarded quite nicely for that. So let's now rejoin the example and have a look at what's occurring. So we can see the market has tried to break with this S&T TPO. It's tried to break out of those 70s, but nothing really going on. No shift in the price response, no change in the auction. We can't see, larger set of TPOs, nothing really significant occurring at this point in time. So let's move this on a little bit and see if we can, catch up to the point where we suddenly see a little bit of volatility coming into the market. So we can almost see, again, very little going on in this market, except the second time we now take out, watch the response that we see on this X print. So straight away, bang, the market. Let's pause that a little bit. So we get the XTPO, nice aggressive sudden shift in the price response. So we can see the largest half-hour TPO of the day, almost double the range of any one of these other sets of TPOs that we've had over the course of the day. So a real surge in volume and volatility has come into the market, and this is key when trading tails. You need to see that surge in volume and volatility. The most effective tails are created on a pickup in the volume and volatility. So it's important to understand, as a key characteristic, the better ones tend to come with a surge in volume and volatility. Now note, we popped up to the highs of 164.98, and very quickly, notice within the same Y print, let's watch where this TPO closes. Okay, so what we can see is that what the market managed to do, what the market managed to almost take 2 or 3 or quite some time to do and achieve, it's now suddenly in the same half-hour candle done the entire day's range. So we can see that tail now poking out there. And the minute that next TPO opens, let's pause that for a sec. So the minute that next TPO opens and we close back inside the value area, that is our clue that something has occurred. Now, had you been watching, for instance, the price ladder as we discussed earlier in the module, you would have probably been entering somewhere around this 164.80 area. You wouldn't have necessarily waited for us to get in back below the 164.72. Now, what I want to point out is when you have these tails, one of two things, there's one of two ways you can trade them. Now, the basic premise or the rule of thumb is that the more aggressive the reversal, the more aggressive you need to be. The less aggressive, obviously, the more passive you can be. So what I mean is, for instance, if we go back to our two basic examples, let's say we had our first tail, which the market came up, it found a top, and then reversed and kind of hung around, but slowly went down. In this instance, you can be passive on entry. So what I mean by that is you can wait for a 30-minute candle close. And once that candle closes on the 30-minute and shows you the tail, you can then enter short side trades looking for prices to move lower. If, however, as in this example, we get a very aggressive move and instantly we get the very aggressive response, we are going to need to be far more aggressive. You're almost going to have to be a little bit, preemptive in the tail. And you can only be preemptive by really, really watching that price ladder closely. So this is one of those trade strategies that it's a premium to be able to read the price ladder. However, if you don't have those skill set, you can still take advantage of the setup by entering once we closed that Y TPO, as you can see on the ladder on the left. Now, let's just go back and continue the play. We'll be looking for short side trades now in and around the 65. As you can see, the Y print has taken out almost everything the market's done over the course of the day, and we've then had our flush lower. So we can see how this tail has brought not just volatility with it, but it's also brought some very good downside opportunity. Now note, once, in terms of execution and where we would get out, we would want to get out of the short once we see buyers coming into the market. Now, as you can see here, the A print, notice how the A print is doing a lot of overlap with the Z print. So we can see that buyers are starting to interact with the selling. Now, again, this doesn't necessarily mean we want to get out, but it does mean the aggression and the volatility has begun to slow up somewhat. Now again, remember, we want to get out at the point that buyers step into the market quite aggressively. So we can see the B print continuing and the C print open. So at this point, we're still short. We're still looking to hold on to these trades until such a point that the market tells us it's time to get out. Now what I do want to point out before we move on is, don't forget, when we do have these key tails, they do represent very important reference points in the market. So at some point in the future, we could be looking for potential momentum plays through that tail that we made at the top of the day. Now note, as we can see again, we've seen, the Z print, the A print, the B print, all moving nicely lower over the period of the day, and all of a sudden, we finally take out one of the highs of the previous candle, and that then is our signal now that the momentum is gone, the auction is starting to move sideways, and it's time to exit the short side trades. Now that is the basic premise of the tail trade. Now before we finish off, what I want to show you now is how very different the tail at the high of the day is versus the tail at the low of the day. So let's look at it. As you can see, we've got a C tail at the low and we've got a Y tail at the high. Now if you look at the two different auctions once we made the high, notice how when we had the Y tail, look how quickly the market moved aggressively lower. Whereas when we made the C tail, look how much longer. I mean, still a tail, the market still rotated higher, but notice the difference in the speed and the volatility on the two different tails. Remember, we said the size of the tail is key, and we said the depth of the tail, so how much overlap is key. These are our two key characteristics of our tails, and those are what you want to pay attention to. How big the tail is, where does the tail occur, as well as how are you going to initiate and execute based on whichever tail the market is showing you. So that concludes then our strategy 11. It concludes our reversal strategies as well as the 11 unique strategies we have dealt with throughout this module. I really hope, guys, that you're starting to get a very strong understanding of how developing these strategies, how keeping these strategies so simple can ultimately lead to you making consistent winners. Remember, go and find these examples throughout a number of markets. It doesn't matter what the market is. The principle remains the same. Find loads of examples. Keep working at it. Keep watching these replay functions so that you can develop trust and understanding and belief in your strategies you develop. Remember, ultimately, that practice will make perfect. Good luck. Now, what we spoke about in this section of the module was we started talking about the concept of a certain uncertainty, and the key to that was that at the end of the day you have to take some form of risk. There's always an element of risk in anything you do, and the important thing to understand is that if you can break that barrier, that fear of taking risk, you will become far more successful. And we said how the key to breaking that barrier is nothing more than understanding, the probability of outcomes, or, that the likelihood is in your favor. We then moved on and we spoke quite in depth about that idea of there's no such thing as wrong, and we said how a lot of traders or a lot of people want to preach and say that there are wrong and right trades. There isn't. There's only low probability and high probability, and the important thing to understand is that ultimately our objective is not to be right or wrong, but rather to be green and profitable. We then moved on and we spoke about developing your own playbook. Now, as we've done throughout Module 1, 2, and 3, I've helped you to develop, the basic premise of what a playbook should, have inside of it. But this is not where it ends. This is just the beginning for you as traders. Make sure that you keep these 11 unique strategies that we've developed over Module 3, and make sure you enhance those, but also keep adding to your playbook as you recognize new patterns. We then began and we spoke about our final two strategies in our replay series, and they were the reversal trade strategies, being firstly the gap day gap fill, and we spoke about how this is a wonderful trade strategy in a sense that anyone who sort of panics and is impatient and doesn't show discipline gets punished, and those who can manage to identify and be patient can take advantage. And we said the key to it was, we want to wait for, number one, the gap to be filled, and then number two, we want to wait for the market to re-enter the previous day's range, and number three, we want to see the market re-enter the previous day's value area. At that point, we look to trade between the two value areas. We then went on and we spoke about our tail reversal trade strategy. And the key takeaway from that was, the type of tail, what's created the tail, the length and depth of the tail. And we spoke about, how that tail is in essence created, but also more importantly, what that tail means going forward. And the key takeaway from both these strategies is that if we are patient and we see the observation on our volume profiles, we can take advantage and do very well utilizing these two reversal trade strategies. Congratulations and welcome to your final summary checker of Module 3. So, very briefly, define a reversal strategy in terms of time frame players, initiative or responsive, time objective, volume and volatility, and risk reward. Make sure you interpret this correctly and take your time. Good luck. This will be the last entry into the playbook that I require you to do to complete the course. But remember, this is not the end of your playbook. This is only the beginning of your playbook. So, find strategies 10 and 11, which were the gap day gap fill and the tail reversal, and complete them in the space provided in your playbook in the following markets: E-mini S&P 500, German Bund 10-year, the WTI oil, and the Euro-Dollar FX. Take your time. Don't rush through these strategies. Don't rush. Good luck. I'd like to take this time to say congratulations and well done on completing the volume profiling course. Thank you for believing in me, your mentor. I hope that you've enjoyed this journey. It's been a real adventure creating this course, and my sole objective was to guide you to understanding the volume profiling tool and the key elements in the trading environment that are required. However, it doesn't end here. This is merely the beginning of your trading journey. It's now time to take your understanding to the next level. You're going to do this by continuously developing your playbook and your profitable strategies and ensure you're constantly working hard at them to ensure profitability. I'd like to share my final thoughts with you over 10 phrases. First, develop real skills. This will take time and deliberate practice. Second, every decision you make should have an end objective, which is ultimately to be profitable. Number 3, there is no wrong or right in trading, only high probability and low probability. Number 4, be patient, be determined, be disciplined, and have a very strong work ethic. These are the 4 necessities required for success. Number 5, it only takes one good trade. Number 6, keep it simple. The markets are, after all, only binary. They only go up and down. Number 7, always manage risk first and foremost. Number 8, always remain objective. Number 9, be honest with yourself, be open with yourself, and always be ready to learn. Lastly, number 10, the secret to trading. Understand the game you're playing. Understand the rules that you need to follow, and most importantly, understand yourself. Winston Churchill once said, "Success is going from failure to failure without a loss of enthusiasm." Thank you very much, good luck, and I wish you a successful trading career.